Hey guys, Justin Jones here, Wealthwise Partners. Hope everybody had a great 4th of July. We're going to get right back into our weekly life insurance sales positioning, highlights, training, etc. And today we're going to talk 5 minutes on life insurance. This idea was taken from a good friend, Mr. Don Blanton, in his 10-minute lesson on life insurance. And over the years, I've kind of broken it down a little bit quicker and cut a few things out, added a few things that I like to take it down into a little 5-minute plan. So that's what our topic of discussion is going to be today. So let's go ahead and get started. The whole idea behind this is I'm going to spend a couple of minutes here showing you how to know more about life insurance than roughly 75% of your competitors out there. And we're going to start just by talking about a little bit of life insurance coverage, $500,000 of coverage. There's a minimum and a maximum amount of premium that you can pay for $500,000 of life insurance coverage. And the interesting piece about this is that the minimum amount is determined by the insurance companies, but the maximum is determined by the federal government. So the fact that the federal government is even remotely concerned about how much money someone would put into a life insurance policy says what? Well, it must be good, and it must be good in relation to one subject, and that's taxes. So back in the 80s, the government came in and limited how much premium somebody could put into a life insurance policy. They did this because they had just created some new plans that they wanted people to use. What might those plans be? We call them qualified plans. So what do qualified plans do? They defer taxes, but they also defer the tax calculation. Think about that for a minute. The government didn't say you don't owe us money. They said you can pay us later. I have a different word I like to use, and that's postpone. Not tax deferred, tax postponed. But before you even get into talking about qualified plans, and we're not going to cover them in detail today, there's two questions you need to be asking yourself. Are taxes going up or going down? And what deductions are you going to have when you take that money? Because if you look at the history of taxes, I think there's a good argument to be made that taxes are more than likely going to go up. The other issue is this idea of the tax threshold. The federal government sets the threshold at which they're going to start that tax and also which levels they're going to tax at. So let's go back to talking about our lesson in life insurance here real quick. In the 1980s, the federal government said, if you put more money in a life insurance policy than we're going to allow, it's going to become a MEC, a modified endowment contract, and we don't want to do that. The reason we do that is because then they'll start treating your life insurance policy like they treat those qualified plans with all the rules, regulations, penalties, etc. And the government, again, is the one setting up the limit on how much you can put into a life insurance policy and still have those benefits. Let's assume that you could buy this policy for $500. Or, on the flip side, you could pay $10,000. $500 is the minimum the insurance company says. $10,000 is the maximum that the government will let you put into it. Which one of those looks better? Probably $500,000 of coverage at a $500 rate. That's what we call term insurance. It's the least amount of premium for the most amount of protection. You get one benefit, and that's the death benefit. That's it. At the higher end, at that $10,000 rate, that insurance company would have to talk you into doing that by putting some additional benefits into that policy, right? If you're going to put $10,000 into something you could buy for $500, there better be a benefit out of that. So let's talk about those benefits for a minute here. Before we get into life insurance, let's forget life insurance for a minute and just talk about retirement plans. Let's list the benefits we would like to see if we could create an ideal plan. I think there are 10 or 11 really important benefits of a plan that you would want if you're going to put your retirement assets into it. First of all, tax deferred growth. Compound interest is the eighth wonder of the world, and if you can get that tax deferred, it's even better. Tax-free distribution. You get your money out tax-free. Competitive return. You wouldn't want something that's only going to get you a small rate of return. What about some additional benefits like creditor protection, long-term care protection, critical illness protection, things of that nature? How about this one? Collateral opportunities. Wouldn't it be nice to be able to use that account as collateral to purchase something so you can borrow against that policy without having to actually use the funds inside of it? What about a safe harbor, a place that the money can be in a safe position as opposed to an invested or risky position? That kind of leads into the no loss provisions, meaning you contractually you can't lose any of your money. It would be pretty nice to have as well. What about guaranteed loan options? What if you had the opportunity to be guaranteed to be able to take out that loan when and how much you want? You don't have to qualify. You don't have to tell anybody why you want it. It's all guaranteed. What about paying that loan back in a fashion that you want to? Unstructured payments, right? No deadlines, no late fees. Pay it back when and how often you want. Liquidity use and control, access to that capital. It's a big benefit. And then finally, the last one would probably be, I'd like to be able to deduct the contributions from my taxes. So that's our magic list of benefits. And obviously, when you're looking to put your money in an account, you'd like to have most of those, right? But now let's get back to talking about life insurance. It's easy to think you want the most protection for the least amount of premium. That's term insurance. And again, with term insurance, you get one benefit and one benefit only. But there's another type of contract that has the highest premium for the least amount of coverage. And now that seems like the total opposite. What it does mean is that you put the most amount of money in for the least amount of coverage and makes that money perform at its maximum potential with 10 of these 11 key benefits. For this life insurance contract, all of these benefits are available inside of a permanent life insurance policy. And when you maximum fund it, when you put the most amount of premium in for the least amount of coverage, you get to have all of these benefits at their maximum potential. And with that, now you know more about how life insurance works and can work than what 75% of your competitors do. Next thing I want you to do is give me a call. Talk to me about your next client. Let's go through this with you so you can have this 5-minute discussion with them about how life insurance works and how to start thinking about it, how to really maximize the efficiency of their retirement plan without having any of the risks that are associated with it. Okay? That's the whole idea behind this life insurance plan. So give me a call. Talk to you soon. Thanks.